Markets cheered better than expected earnings from Apple, Microsoft, and IBM, and bid mutual funds up about 1.83% for the week ended January 25th, 2012. Hi, my name is Tom Rosine. Welcome to our edition of Lipper's Fund Flows Insight. You know, we had the positive news, we had some really good numbers, but we actually ended up in negative performance territory, or actually negative flow territory. We saw investors redeem about $13.9 billion from the conventional fund business. Let's take a look at our macro groups to see how those areas shook out. If we take a look, equity funds actually saw about $1.1 billion in net inflows. Taxable bond funds, really nice week, $3.7 billion in inflows, and muni bond funds saw $0.5 billion. And of course, the pariah then would have to be money market funds. Investors took about $19.2 billion out of money market funds. We'll give you a little bit more on that as we move along. Well, if we focus on equity funds and try to get a breakout of where the money actually was moving, we get actually a pretty good week. For the sixth consecutive week, we saw about 1.83% return, which was a pretty good return on a weekly basis. But if we take a look at the flows, is $1.1 billion. It was the third consecutive week that we've seen inflows, and the breakout is a little bit different than we've seen in the past. Domestic equity funds actually were on top, taking in about $0.8 billion, while non-domestic equity funds saw about $0.3 billion in net inflows. Breaking these down into two different groups, so I took a look at emerging market funds and saw they took in about $567 million, while the ever popular, and over the last several weeks we've all been talking about it, equity income funds took in about $534 million. That was really some grand numbers. Last week, Matt and a few other folks in previous weeks talked about ETFs and how important ETFs have been to flows to equity universe. It certainly didn't change this week. $6.6 billion came into equity funds via the ETF application. However, what we take a look at it, we saw three broad-based groups actually taking in money. Each took in about $1.2 billion. We saw IWM, which basically is the iShares Russell 2000. It took in about $1.1 billion. We took the Power Shares, actually QQQ, which is a mimic of the NASDAQ, took in about 1.1, and the Spider SPY, S&P 500 ETF, took in about $1.1 billion. So it really was very well dispersed, and it wasn't just focused in one particular area. So we do see investors actually taking on a little bit more risk and being a little bit more bold in their moves. Let's go ahead now and move to fixed income funds. Fixed income funds had a grand week, took in about $3.7 billion. This is the sixth consecutive week that we've seen inflows, and the sixth consecutive week we've seen plus side performance. They got about 0.58% return. At the top of the class, we saw corporate investment grade debt funds, a very popular asset class, taking about $987 million. That was a grand number, but really the story I think for the week has been the high yield. High yield took in about $866 million, but it was the eighth consecutive week that we've seen inflows into this asset group, and this caused us to actually do a little bit of poke as well on what happened on the ETF side, and we saw about the equal amount of money in 9 different funds now accumulate to about $800 million in inflows. And what was really kind of a phenomenal number, it was the largest inflows that we've seen in ETFs since we started tracking these funds since their creation in 2007. So one of the things that we said is that we've seen good performance on the equity side, which we just got done talking about, and also high yield funds have been on a big attractor piece. And that might cause a little concern as we go forward, just because first of all, as you bid up high yield, that means their yield's going to drop, and secondly, we've had such a long period of time that these have been being bid up that in fact that's maybe why people put money into the ETF portion of that particular asset grouping, is because then they can pull the trigger pretty quick and get out if they need to. Well, enough of that. Let's move on to municipal debt funds. Municipal debt funds for the first week in 10 actually had negative performance. They lost about 0.30%. Again, this is for the week ended Wednesday, January 25th, 2012, but it was the 8th consecutive week of inflows. We saw about $479 million go into this group. Now, in particular, when we take a look at it, national munis took in about 391, single state munis took up the rest. So we've seen an interest in interest-bearing securities. So this whole thing that we've been looking at, even through equity funds, equity income funds, taking a look at the high yield funds and now muni bond funds, people are looking for yield, and we see money flowing in that area. Now, an area that we've been actually absent of yield for quite some time has been money market funds, and money market funds saw about $19.2 billion in outflows. As the second consecutive week, or the fourth week in 5 in which we've seen outflows out of this group. Taxable money market funds, basically saw $16.8 billion in outflows, made up of $10.8 billion from institutional investors and $6 billion from the retail investor. And this is not too surprising. People either have to put money back to work, that's why they were saving it in the first place, or we have people already getting ready to pay taxes. They're turning around and taking money out and putting it into work. The last piece that we take a look at is the tax-exempt portion of money market funds. And we saw that they lost about $2.4 billion. Again, people just putting money back to work. So really, it was quite a positive story, even though we had 19.2 in outflows from money market funds, and actually a net out of the conventional fund business about $13.9 billion. But as we move forward, we're going to be looking at a couple things. First of all, this morning we got a lower than expected fourth quarter GDP view. It came in about 2.8%. I think people were hoping about 2.93. I don't think that's actually a real big deal, but again, people will keep their eyes on it. Earnings reports have been pretty good. About 63% of those funds that have or stocks that have reported for the S&P has actually beaten expectations, so it looks pretty good. Not as good as prior quarters, but again, something to look up to. But one of the disappointing things that came across as well is Ford Motor Company. Even though they reported their 11th quarter of profit, it actually missed expectations. So as we have a little bit of a disappointment, we've had a pretty good run over the last several weeks. Maybe we might expect some outflows and some counter movements as we get going into the next quarter, which is going to be coming in just a week. So if you want to dig a little bit deeper though and take a look at some of the areas that you have interest in, you can go to our site, lipperusfundflows.com, and do a little bit deeper dive. If not, you can join us next week. One of our analysts talk to you about fund flows at that time. Until next time, my name's Tom Rosine, wishing you the best in your wealth planning and creation.